the economy and the stock market are very different things right now. And so much so in the financialization of everything that it's not so much that, we're kind of not in an environment where the economy necessarily leads the market. It's the market leads the economy, really.
Bond yields are skyrocketing. The Federal Reserve looks poised to start cutting rates, even though inflation is still running hot. And gold keeps making new all-time highs as investors are scrambling to find a safe place to hide. Hello and welcome to Milk Road Macro, the podcast that believes that investing is like watching a good horror movie. You know everything is going to be okay in the end, but sometimes it's just more fun to panic. I'm your host, John Gillen. Today is Wednesday, September 3rd, and today we are joined by Quinn Thompson. Quinn is the founder and CIO of Lekker Capital, a discretionary hedge fund focused on the intersection of macro and digital assets. Prior to launching this fund, Quinn built his career at Guggenheim Partners and served as head of capital markets at digital asset firms, most recently Maple Finance. Quinn co-hosts the weekly roundup on the Forward Guidance podcast, where he discusses macro markets and what to do about them. Quinn is the perfect guest to break down everything that's going on in the world of macro right now. So if that sounds good to you, make sure you like and subscribe. Share this episode with somebody who's going to enjoy it. And as a reminder, our Milk Road Macro research team lives and breathes macro. Every month we drop a no-fluff report on what really matters in macro. The latest report we had, I think, had over 40 different charts in it, painting a complete picture of macro, breaking it all down in plain English that's accessible and easy to understand. So if you want to get on the alpha, join our pro community today. Link is below in the show notes. As a reminder, today's episode is brought to you by KGeN, the verified distribution protocol changing the growth game. So make sure you support our sponsors as they support us. And without further ado, welcome to Milk Road Macro. Quinn Thompson, how are you, sir?
Good. How are you?
I'm good, man. I think this is going to be an interesting month. I'm really excited to have you on to kind of break down what's going on in the markets right now. I'm happy to have a great conversation today. I wanted to start with what in many respects is the most boring, but also the most important thing in the macro landscape, which is the bond market. And I wanted to start with this chart here and just kind of show this to the audience. The 30-year government bonds from a lot of countries, not just the United States, are spiking. The rates, the yields keep going higher. And I just wanted to start with this and get your thoughts on this as the backdrop of the macro landscape right now. What message is this sending to investors, and what should we take away from these rising yields in bonds across all these different nations?
Yeah, it's really been the same trend just persisting since COVID, where governments have not ended the fiscal deficit spending that they began as emergency measures to lift the economy out of the government mandated lockdowns in 2020. And here we are 5 years later, still running the same playbook and not actually rebalancing those deficits back down to a sustainable level. And so when you have, particularly here in the US, but it's a global phenomenon, everybody's in on it, government spending 5 to 7% deficits of GDP each year, and then, requiring some form or fashion of liquidity support from central banks and issuance dynamics, other sorts of stimulative measures to support that issuance. You get people who basically go on a buyer strike and decide that when gold's been up and to the left, left to right to the sky for the last 3 years, and bonds have been the opposite, you probably want to start rethinking your stores of value. So yeah, it's a global problem. I think the before this period, the last kind of 20 years we lived in, FX relative pairs, euro dollar, euro yen, dollar yen, GBP, these sort of mattered more, or at least they still matter, but provided more signal because there was semblance of like running responsible fiscal and monetary policy. And you can just plot any of those versus gold today and see that they're all depreciating at a very rapid pace. And so those fiat to fiat currency pairs are providing, I think, less signal. And the bond market is sort of taking over for that signal in the world we're in. So yeah, I think my message has been very consistent for a while. I think the best, one of the best assets and the average American can have is a 30-year mortgage. I don't really see long-term interest rates, bond yields going much lower than where they're at, even if we got some sort of slowdown, and it would be a very temporary thing because we know what would happen to the deficits on the other side of that. So yeah, I just expect a continued gradual, multi-year trend of rising yields to continue.
So I think what you're describing here makes a lot of sense. It's basically what you're saying is during COVID, a lot of these governments had to go to pretty extreme fiscal measures to keep their economies solvent, and they haven't really unwound those practices. And that's just what we're continuing to see is we've sort of destroyed demand for long dated government debt. I have a couple of questions I want to ask about this, but I'll just start with this is like, you've said you expect this trend to continue. What do you think would have to happen to bring back investor demand for those long dated bonds? Or do you think that that's not really a realistic outcome and that the governments are going to have to get, let's say, more creative about other measures to find a solution because that demand for these long dated bonds is never coming back?
Yeah, I don't think it's going to happen. Just given the repeated, fool me once, shame on you, fool me twice, shame on me type of thing. We just know these behaviors are not fixed until there's a crisis. So I don't really think it's going to happen, but sustainably for it to happen, because this is what I just described is a secular trend. And so for that to sustainably fix itself, on that long term, we're talking multi-year secular trend basis, you would want to see, either primarily deficits go down. There's not an unlimited demand for government debt, and governments are spending as if there is. Sort of like you and I don't, we can't just go to every bank and unlimited demand for our, leverage. That's what they're kind of finding out. And so sustainably, you need deficits to kind of come back in line. Other things, though, more cyclically, which is what the Trump administration is trying to do, is via tariffs and the immigration slowdown, is to try and put cyclical dampening pressure on yields in order to, kind of bring down the cost of capital. But it's this weird world where, two-speed economy, you have Main Street in a recession, and you have, high-end rates too high, but you have them putting downward pressure on artificially in some senses on the long end, and that's supporting financial markets. So that's what's really fueling this big divide. And we've seen it over the years in NASDAQ for small caps and other sort of inequality measures. But you really need it to go through Congress to fix it. But we know that that's very unlikely until there's a real crisis. I mean, in the 70s and 80s inflation period, we think of 2022 where inflation was rising, and when the Fed was hiking rates, the market was going down because everyone's like, okay, cost of capital is going up, the Fed's hiking rates, pulling liquidity from the market, assets are going down. What ended the really bad inflation era of the 70s and early 80s was when Volcker hiked rates. Stocks actually bottomed. When stocks bottomed coming out of the last big inflationary period, it was on the back of rate hikes because people said, finally, okay, they're getting serious about this inflation problem. So that's just something to think about. And it seems like we're still a decently far ways away from that.
Yeah. So the way I've been interpreting this myself is that this is the market getting more serious about demanding changes from Congress, from legislatures about the budget, about the deficit spending. And that's why all these long dated bonds are going so high, is that investors are saying like, hey, we don't believe you're going to be fiscally solvent 30 years from now, so we're not willing to pay for these bonds. And so I think this is something where, like, this trend is, like you said, we expect this to continue because it's very unlikely that governments are going to change their policies around this because it's very unpopular with their electorates. I've been following your work and thoughts on this. You've talked a lot about the risk of bond vigilantes taking control of the market if the Fed continues this policy of like adding liquidity and, selling a lot of T-bills and, front dated issuance of new debt. Define for our audience, what is a bond vigilante? I think just like some people would like benefit from knowing some more of these basic terms around this, but like, what is a bond vigilante and how are they going to react? We'll talk about the Fed in a minute, but if the Fed does cut rates in September, how do you think the bond markets are going to react? What do you think is going to happen from here if that comes into play later in September?
Yeah, vigilante, just like on the street, a vigilante, like a civil, just normal citizen, kind of let's say enforcing justice because they believe the governments or peacekeepers are unable to adequately govern themselves. So it's really just people rebelling against the government bond market, which is historically seen as a very safe haven, risk off asset. And so last September when the Fed came in with 50, you saw the bond market yields rise, bond market sell off. and that came at a time when growth actually rebounded pretty decently. The difference this go around, and they're going to cut in September with today's JOLTS data. It sort of locks it in, and Powell said as much. So I think that's sort of baked in the cake. It's more of what comes next is the question. Is it October? Is it December? Is it January? How many we get? But the difference this year from last is that the labor market is markedly weaker. Consumption is markedly weaker. Less services due to tariff pullback from the consumer, as well as immigration reduction, and the break even level of employment growth is much lower. Just part of that is due to slower economy, and then also the immigration thing. So I don't envision if the bond market were to sell off and yields really rise here, I think it would be less about a Fed policy error, because I think the economy is weaker. And I think it would be more about a liquidity problem where we've seen auctions start to, just a supply. It's really a supply problem. The TGA refill, foreign buyers, given tariffs, are reducing our trade deficit. That means less dollars in the hands of foreigners. They're just a structurally smaller and smaller buyer as we proceed over time. And you have sort of the private sector, not really in love with bonds here. So it really has to come forced by the banks, which is why they did the SLR. So moral of the story is I do think the economy is weakening. I think that in a normal course, front end rates should be lower. But they've been doing this thing where they've been supporting duration, the back end, which has supported asset prices and markets, which has kept the economy artificially strong, and therefore have forced them to keep short-term rates even higher so than they would. But I expect it to come down, and as we all know, Trump is well on his way to overtaking the Fed board with admin plants. So it's very likely between now and next June that rates are at least 50, probably 75 or 100 bips lower.
Yeah, so this is kind of the next topic I wanted to get your thoughts on. A lot of things going on with the Federal Reserve. So let's just start with the rate cuts, right? I think I've heard a lot of macro analysts disagreeing about how many rate cuts are needed, if it's a policy mistake or not. A lot of people, even some people from the Forward Guidance podcast have been saying that the real risk is of inflation and the economy running too hot, as opposed to the labor market softening. But like you said, the jobs data has been weak, and that seems to be the rationale that they're going for here. What happens after these rate cuts? Do bond yields go higher? Do we get like a sugar rush of like everybody being like, oh, we're back to a bull run? Like, how do you think that the market is going to digest these rate cuts? If it's 25 bips, 50 bips between now and the end of the year, like what do you think the response is going to be?
So reading between the tea leaves of the debates going on in finance circles right now, whether or not it's a policy error or if the Fed should be cutting and how much they should be cutting, I think is indicative of actually the underlying unsaid truth of the situation, which is the current problems facing the economy and markets are not really Fed controllable things. We're seeing tariffs being, causing some sort of inflation, push in the short term, but probably abating, and actually more in the short term is actually a growth hit. So that's not something they really can control, and it's not very clear that 25, 50, 75 basis points of cuts fixes that either. And immigration, which has effectively overnight been cut to zero, and lowering the aggregate output capacity of our economy with less population growth, and then therefore brought down the break even jobs growth numbers. Again, not something the Fed can control or fix. Like, Fed cuts don't bring more people to the country to work, and then I think on top of that, the third major and probably the biggest sort of market impact of the last multiple years, but certainly this year too, is the actions of the Treasury and the different ways you can manipulate liquidity and Treasury bond issuance there. So it's really I think the crux of the situation is that the Fed's tools are not what are needed to fix the problems. But where I think people have differing views and some get maybe upset about is when the Fed does act to provide liquidity and stimulate to fix problems that their policies can't actually control, they benefit, continue to push this, asset price inflation, and many would say an AI bubble or crypto bubble or whatever, sort of however you want to describe the asset price inflation that's ongoing. That is a Fed driven thing, and I think that's where that's leading to inequality, and we know all those stats, and that's where a lot of people have a problem with. So what they really need to do is they need to bring down front end rates by 50 to 75 basis points, and they need to let the long end actually do what it's supposed to do, and the curve should steepen, and they should probably be 50, an equivalent amount, maybe not much higher, or maybe just here, but that wouldn't be so great for Mag 7 stocks and indices that are comprised of 40% of just a couple names. So it's this delicate balance where basically the Fed's going to walk down the interest rate slowly, and that probably doesn't, because it's done slowly and because there's so much cyclical pressure on growth right now, that it probably doesn't really create a long end yield problem, like we saw in 2024, particularly after this TGA refill time. But September, there's some liquidity dynamics that are a bit hairier than most months of the year.
Most Web3 projects launch a token first, and revenue, maybe later, maybe never. But KGeN flipped the script. $30.6 million in ARR before a token ever existed thanks to VeriFi. Cash flow positive, growing month after month, and powering 31 million verified users across AI, gaming, and consumer apps. In a market full of hype and empty metrics, KGeN is proving that Web3 can be built on real revenue, real users, and sustainable growth. Want your protocol to scale with results that last? Grow with KGeN today at milkroad.com/KGeN. Right. Yeah. So there's some seasonality to this right now as well. There's a lot of things in that answer. I think I want to start with, so before we move on from the Fed, I want to get your thoughts on Trump's strategy with, Lisa Cook and Jerome Powell, how the Fed actually sets policy, like how many members are voting, like the board, the regional banks. I want you to lay that out for the audience, because I think you've done a great job of like analyzing what his strategy there is and how the Fed actually votes and changes policy. Because a lot of people don't really know. Like Jerome Powell comes out and like says what's happening, but he's really just the mouthpiece for this larger organization. So give us some context there. And then I want to move on to, like you said, like risk asset valuations and how recessions are kind of outlawed. And like, we can talk about like how to play this in the market. But before we move on from the Fed, let's go to that piece about what's Trump's strategy with getting control of the board of governors, and then who are the voting members, and how the regional banks get a voice in this. Like, lay that out for our audience so people understand that.
Yeah. So the Fed they meet 9 times a year, I believe it is. And there's 12 people that vote every meeting on what their policy actions are going to be. There's usually consensus. Sometimes there's some dissents. And that 12 member voting group is comprised of 7 governors, board governors, and then 5 regional bank presidents. And there's more than 5 regional Fed banks in the country, but every year they rotate who gets to vote as part of the meetings. And the Fed independence thing, they've never been really independent. Presidential political pressure on the Fed has been something that's dated back decades and decades and decades. That'll never change. It's such an important driver. It's just become more sort of in your face at this point. And really what Trump's strategy is to dampen growth with the immigration reduction, the tariffs. Those are growth dampeners. And, he wasn't handed a particularly strong economy. It was actually a pretty weak economy to begin with. And he's trying to offset those downward pressures on the market with liquidity. And what it's doing is at the moment just kind of increasing the divide, because we know that asset owners are the wealthy in the country. And so his policy is basically, the Fed has probably 50 to 100 base points of cuts in the tank, quote unquote, to get to what they would call neutral at current approximate or next couple months approximate inflation estimates. But what we saw even last year when they cut 4 times 100 base points in 4 months in Q4 was it created a little bounce in the economy, but it didn't resuscitate, the economy. It was a for better lack of a better word, dead cat bounce, really, in terms of job growth and all sorts of economic metrics. And so what he's trying to do is trying to front run all these negative economic effects with market liquidity. And he's well aware that a 25 basis point cut here and there is not enough really to do so. And so the quicker he can get those cuts through, because if you front load the liquidity, you have a better chance of sort of sustaining the market and helping investors. Ample liquidity would help investors see through. The other thing is that ultimately, I think, given they have chosen this path of running the continued Biden era deficits, and they've cemented those in for numerous years, they're going to need bond market support in the future as well. Like the just pure supply, as we've seen in that yields chart, it's just a straight line with a bunch of bumps, but the trend is clear. And if deficits are remaining where they're at, they're going to need, foreign buyers are gone, private sector's full. They need buyers of that debt, and ultimately that's going to come from the Fed. So he's basically trying to bum rush the Fed to get liquidity via rate cuts or some sort of QE or other supportive measure as soon as possible. And it's important because there's this, these things, there's real life dynamics to the liquidity issues. And the Treasury has to issue the debt. If they're running 6% deficits, they can't just say we're not going to issue the debt. They run out of cash. So there's so much pressure, and it's so urgent because, it's kind of a race against the clock for him.
Right. There's a time component of all this, and there's a crisis that's brewing. I've never heard anybody say the phrase "bum rush the Fed" before, but that is effectively what he's doing, right? He went down and like physically and publicly kind of as like bullied Jerome Powell, and is trying to fire Lisa Cook. So just so the audience understands, the reason why you're saying he wants to get controlling interest in policy at the Fed is that there's a urgent need to change monetary policy in Trump's view in order to support the markets and make sure that this crisis doesn't get worse. And that's why he's putting so much pressure on trying to get control of the board. Also, in 2026 is when the Fed Board of Governors is going to vote to reaffirm a lot of these regional bank governors. The regional bank governors also get a vote when the Fed changes policy. So Trump is playing a very long game here, but he needs to get control of the board of the Fed pretty quickly in order to win that game. So that's why he's putting so much pressure on this. I wanted the audience to understand that context there. Mm-hmm. I think with kind of the rest of our time here, I'd really like to get your thoughts on the market implications of all of this, right? Like, so we've talked about bond vigilantes punishing governments for irresponsible fiscal and monetary policy, or fiscal policy, let's say, spending huge amounts on deficit. And so the bond vigilantes are not buying the government bonds, but where they're going to seek refuge in the market, I think is a really interesting thing. And it's something I want to get your thoughts on. I thought I would bring in this chart here to show this, but like gold has been on an epic run, right? And if you kind of like overlay this with the rising yields, it shows that at least some of the capital that is leaving the bond markets is looking for safety in inflation hedges like gold, other products. Obviously, we've seen a huge bull run in U.S. equities and risk assets. I want to get your thoughts on this. Like, where do you think that this capital is going? Do you think gold is going to get to 5,000-6,000? Do you think it's going to just keep pushing the risk markets, or like the equities markets higher? What is your forecast for how this plays out in the market, and what do investors need to watch out for there?
Yeah, so we've been telling investors since July that we think gold is the best risk reward asset in the market, and quite a bit better than, let's say, Bitcoin. So that's been all right. I mean, the breakout has been monstrous this week. So, I'm in position. I really like gold, and we haven't even gotten to the like full Fed takeover, and this is the action here. So, I would say that I think this breakout is legit. I mean, it was consolidating for 4 or 5 months. It's in a raging bull market, has been for years, and you look at a lot of like futures interest and ETF flows and things like that. It hasn't been nearly the hype, despite it being a much larger asset, as like crypto, Bitcoin. The flows haven't nearly resembled. So, you also have this persistent central bank bid, as you know. I mean, countries like China, Japan, UK, these guys own like trillions of US treasuries, and we're feuding with with China and India and I mean, so, and there's sanctions risk. Don't forget, in 2022 we froze Russia's assets, and it doesn't appear that much of this geopolitical stuff is calming. I mean, China's not bending over for our requests, and so that trend's going to continue, and they're accumulating gold because it is a real safe haven. So I really like it. I think, generally speaking, what April showed us was that the appetite for any sort of fiscal responsibility and actually balancing the budget, or taking pain more or less, to rebalance the economy, is just sort of off limits. And in that case, that's why yields continue to rise, because the government is making a decision. We just had Powell's speech at they updated the Fed framework, where he basically said, there's a lot of talk about that speech, by the way, which some people, I think it's a very long-term thing where it matters. I don't think those changes matter as much now, but the big change was back in 2020 in the review. They said, okay, inflation's been running very low, below our 2% target. We're going to move to this average inflation targeting regime, where if inflation runs below our target for a couple of years, well, then we're okay letting it run above our target for a couple of years. Okay, well, so we got that. And then we got the run above, which we've been above target for 4 years. And now they're saying for their go forward 5-year policy, they're removing that to say, okay, it's run above. We no longer need it. We're no longer doing average. We're no longer saying, okay, we've run above for 2% for 4 years. Now let's try and run below for a number of years. They're saying, no, scrap that. So you're basically removing that left tail of inflation downside. And so in this world, you are basically left with purchasing power protections via assets that can't be printed. And you look at the precious metals market, it's got a market cap in maybe 10, 20 something in there trillions across a bunch of them, but central banks own the majority of it. So it's actually a much smaller market than you think. And then you have energy assets, natural gas, oil, you have other metals and commodities used for industrial purposes, copper, etc., which you can't print. And we've been in a maybe 10 plus year stretch of underinvestment into all of these hard assets, as we've kind of let the middle and lower income class drown in this 2-speed economy, and eventually that's going to have to change. And so that's where you're seeing the performance.
Yeah. So I put up this chart here to just reflect the personal consumption expenditures. Like you said, like inflation has, like the Fed has had this target of getting back to 2%, and now they're kind of pivoting. After the speech at Jackson Hole, saying like, oh, we'll be in a range. They're kind of sort of like tacitly admitting like, hey, we've kind of lost the war on inflation. And so in order to support the labor market, we're going to pivot to more accommodative policy. But that does mean that investors need to be aware that, hey, there's going to be a more inflationary environment. You have to protect yourself. A lot of people are turning to gold. Last week on the podcast, I had Chris Kuiper on, who's a VP of research at Fidelity's Digital Assets. He was talking about something that, former colleagues of mine at BlackRock also were saying, which is that institutional investors are beginning to pivot their thinking on Bitcoin from a risk on to a risk off asset, meaning that a lot of people buy Bitcoin for the alpha, for the outperformance, but because it is a decentralized, immutable, non-sovereign store of value, the fixed limited supply, it also can play a role in an investor's portfolio to hedge against just this kind of situation, right? Like this mass debasement of currency and overvaluation of risk assets. Do you agree with that thesis? Do you see that turning for Bitcoin? And do you think that Bitcoin is going to follow gold higher? Because historically, that's kind of been the case. Like gold moves first and then Bitcoin will follow it. What do you make of that? Do you think that's like wishful thinking? Do you think that's maybe in the future, but not here yet? What are your thoughts on that?
Parts of it I do. I do think it embodies some components of digital gold. It's benefits when there's a weak dollar. It has done very well in the debasement era that we're in. So over long periods of time, I do generally think it's sort of that faster horse, call it. But with that said, Bitcoin has never performed when the VIX rises like that. Gold does oftentimes. So it's from that perspective, it's very much still a risk on asset. The other thing is, uh, one has the world's largest central banks accumulating it, and the other has, uh, you know, the worst people call them are Ponzi's. The best people call them are digital asset
We
treasury
can skip
companies.
over this. People who aren't central banks are accumulating
Something
it.
in the
I get what
middle,
you're saying.
maybe something in the middle. So those are different accumulation vehicles that one creates a money supply and one, uh, so I think it's a very, very good asset to trade. And I'm a very long-term structural bull of Bitcoin. I think for all of these reasons we've laid out, like, I think you're going to make the most money on it. We're talking about this gold breakout and it's like 3%. And we're like, oh my God, gold. And it's like, when Bitcoin does 3% like 4 times a day. So, when we're talking about like millennials who want to trade things with vol and, obviously Bitcoin, but it's not a true store value. It's just not big enough. It's not mature enough. The ownership base has not evolved enough, where it can truly rival gold. But there are some components that, give you hope that one day it will become more performative in a risk off period.
Sure. Yeah. And I think that that's sort of the unfolding of this story, right? Like the evolution of the asset. And so I want to get your thoughts on this, because like I said, you've spent a lot of your career at this intersection of macro and digital assets. Thoughts on Bitcoin towards the end of the year, right? Like we've talked about, Fed rate cuts are coming. A lot of people are expecting increased liquidity. The TGA refill will be over, so that drag on liquidity is going to be done. Traditionally, Bitcoin has performed well in that kind of an environment. So, do you expect that bull run to continue into digital assets, into Bitcoin? Like, what is your forecast for that for the rest of this year?
Yeah, this year's been interesting. It's probably been one of the most unique periods of time because there's many metrics that would have said the cycle should have been over, and then we've sort of gotten this elongated extension due to pretty much the Fed takeover and some of these other treasury mechanics that have bolstered risk assets, including Bitcoin. And so I think September's a big month. I think it presents the, let's say, riskiest of the final few months of the year in terms of liquidity dynamics, corporate buyback blackout, and some other things we're watching materialize here. And so I think if it holds in and broader risk assets hold in through the end of the month, into October, you're probably looking at a rally, going into year end, and you could get this traditional Santa rally seasonality things. There's other reasons why I believe this, but this period I think is very important. The other component that obviously everyone is well aware of on the digital asset treasuries that have been the biggest buyers in the market of both Bitcoin and ETH, and maybe Sol now for that matter, is those premiums are waning. So anything, it's a supply demand. Financial markets at its in the short term are supply demand machines, and one of the biggest drivers of demand is probably not done. None of they're still purchasing, but it's waning in terms of what they can do. So it's a tough thing to say, because if you had a risk off event and all these premiums were wiped away in the next few weeks, well, the outlook's not so great, because the thing everybody's relying on to provide them exit liquidity is not there. On the contrary, you could maybe get liquidity support, accelerated Fed cuts, Lisa Cook gone. We see 3 cuts this year, maybe, and then you have a very, very attractive liquidity outlook that Bitcoin would meaningfully benefit from. So it's I think it pays to be a little patient here over the next few weeks. And if you like, it's a long 4 months left in the year, right? We're September 3rd. My view is that if we make it, Bitcoin's not going to shoot up to 160K, in the next month. And traditionally, the last few months are the best if it's a supportive environment. And so you probably have, the risk reward here tells me, just stay patient on risk assets. I mean, stocks, S&P, NASDAQ, they're sort of not doing anything. So I don't think you lose much by sitting here waiting for the breakout to new highs versus front running it. And maybe you get a couple points off. You can buy it cheaper. Maybe you have to buy it on the breakout, but I think it pays to be patient in September.
Yeah, I agree with this a lot. And I think that it's kind of like this, the sports analogy I would use here is like the last few minutes of any sporting event are usually like 30% of the total play time. Like the last 2 minutes of an American football game can take an hour. It seems like, and a lot of activity and action happens then. So, like whatever happens in September, we might go down a little bit. We might see some corrections still, but the last quarter this year, I do expect some upward volatility in a lot of risk assets. So I'm just trying to do the same thing: is like be patient, not be dogmatic about what must happen, but watch what does, and just kind of like play the hand that's dealt. I think the last question I wanted to ask about this. So okay, I want to go back to a comment you made earlier. I think that you said like the cycle has been extended. I think the way I would characterize it has been sort of delayed, and it seems like we're now coming to a point where we might actually get a lot of this cycle, right? Like the ISM, manufacturing ISM has not kicked up over 50. So like a lot of indicators would say like, and you mentioned like by some measures Bitcoin people would expect has topped by now, but like by like I think there's like 30 different on-chain indicators that people use to measure the cycle top of Bitcoin historically, and none of them have fired or really even gotten close. So I think it's like a delayed thing. And so I'm curious your thoughts on this. Do you think that we are going to get, like in Q4, we both are expecting some upside. Do you think that's going to be the top, or do you think it's going to be one of these things where it's like it just kind of keeps going and they keep this Ponzi running and keep overinflating risk assets? Like, how far can they extend this? Like, where do you think this is going to run?
Yeah, I have no idea, to be honest.
Okay.
So, but they're gonna try, and
right,
and so that counts for something. I think that what we do is we're kind of at the intersection, like you mentioned, of traditional assets in crypto, and have backgrounds in commodities, credit, a number of other segments of the market where we try to outperform a combination of a split between S&P 500 and Bitcoin, and so we don't have to own crypto at all times. Sometimes we'll be long, sometimes we'll be neutral, occasionally short, but and sometimes we just avoid it. If there could be there's a world where the next, here's one that probably people would not even really imagine, is there's a world where the next round of QE is actually bearish for tech stocks because this is the first, second, third time, something less than a handful of times ever where the Fed has cut rates when ISM's over 50 and core CPI is above 3. And so if you get QE rate cuts, all this stuff now, I mean, that's why you're seeing gold ripping is people are saying, well, they're supporting this economy. Like they're sort of ignoring any inflation concerns. We know increasing the money supply via cuts and these measures, are inflationary. And so people are choosing to protect their capital via commodities and other stores of value. And there's a world where, QE and cuts when inflation's zero at the depths of COVID or 2019, that's one thing. QE or cuts when inflation's 3 and rising. We don't know what happens in that environment. So I just think asset selection is super important. I think that, particularly outside of Bitcoin and in the crypto space, it's long tail, high beta technology. And in a maybe not hyperinflationary, but in an inflationary, stagflationary world, you see multiples on risk assets come down, and that would affect them. So yeah, it really comes down to liquidity. I think the other thing I just add, at risk of talking too much, is it's sometimes funny because I think everybody in this market recognizes that fundamentals aren't really what things trade on when NASDAQ's trading 25, 26 all-time record valuation multiples. And you have, all the, just the speculation we all know is rampant. And so pretty much every market participant agrees that, the Benjamin Graham value investor, price to earnings, all these things are not what the market's trading on. And we all know the phrase markets can be rational longer than you can stay solvent. And so shorting it's difficult. And that's what makes these, late stage bull markets very difficult to play from. You might know there's going to be something brewing negatively on the back end, but you probably get stopped out 40 times on the way up. But at the same time, so if you believe that we're not in a market that trades on fundamentals, then almost by definition, you also can't believe that the markets and the economy are the same thing, because fundamentals are tied to the economy. GDP is growing 5%, presumably top line revenues of the S&P is going to grow 5% and earnings are going to be growing 5%, And so if that matters, then, we see that reflected in stocks. If everybody agrees that doesn't really matter, then it's also fair to say that the economy and the stock market are very different things right now. And so much so in the financialization of everything that it's not so much that, we're kind of not in an environment where the economy necessarily leads the market. It's the market leads the economy, really. So that's something I think people should be wary of. Just when you hear, oh, the economy's fine, no recession, rate cuts are coming, these sorts of things, they very well could be very positive. And in many cases they are, but just making sure you're thinking first principles through all of these things. Does a 25 basis point rate cut, really move the needle? I just said the economy's fine, but I also just said to this other person that nothing trades on fundamentals. And so what do they trade on? Liquidity, flow dynamics, these other things that you sort of have to be looking out for now, and just this different market environment.
Yeah. So when I was back in school studying macroeconomics, on every question on my final exam, our professor was a stickler about this. He made everybody write the words ceteris paribus, which is a Latin phrase, which means all else being equal. And so what I want the audience to understand about what Quinn is saying here is that when people say things like, oh, rate cuts should be stimulative, we should get a bull run, that's maybe historically true, but a lot has changed. And the market that we're in now is different than the markets we've had in the past. The policies that are applied are going to be different. They're going to have different outcomes. And so you can't just look one-to-one and say like, well, this is what happened in the 40s or the 70s, and this is what's going to happen today, because the circumstances are different. I think what you pointed out about how, the Fed is looking at economic indicators like inflation or jobs and making monetary policy decisions based on that, whereas the market is valuing risk assets like gold, Bitcoin, other things on things that are not really tied to those same economic indicators. And so this creates this kind of a confusing environment for investors, right? Where you say like, okay, maybe all these things are in a bubble. However, the risk of not participating in the bubble, if the bubble keeps going, right, and just keeps going and keeps going, and you're still sidelined, that's a risk too, right? So nobody wants to be caught in a bubble. However, if you're not participating in the markets and everything is financialized and these, in nominal terms, you're just getting destroyed in your real value, right? So like this is kind of the catch-22 that investors are in. Quinn, I think we've covered a lot of topics. I've learned a lot. I've gotten confused, which I think is always a good sign when you're trying to learn about macro. Let's sort of land the plane here for investors. Our audience is mostly retail. They're here to learn about macro because they know it's important, but they sometimes have difficulty. Like somebody in our Discord was recently telling me that they kind of like glaze over when they're trying to digest all these things. What are some, like maybe like one or two of the key things you would tell investors to pay attention to from a macro perspective as we go into the end of the year? Is it Fed rate cuts? Is it, what are you looking for as like the high level targets or indicators to pay attention to from a macro perspective?
Yeah, it's Fed and Treasury. It's what is, and it's prices. I mean, gold is sort of telling you certain things. I mean, we don't exactly know what in advance, but it's prices, price action, but also really the Fed and Treasury. It's all a liquidity thing from here on out. We know the economy is weakening. I think people know it's generally weakening. I'm not saying, look, the government's spending 6% every year. It's going to be very, very difficult to get a normal recession. Nominally, it's just not going to happen. The recession you might get would be real if it did come, but I'm not in the camp. I think inflation risk is higher than recession risk. So I think watching liquidity and watching small caps and the S&P 493, the non-Mag 7s, because I think if we're going to get this sort of, blow off and really exuberant period, I would expect it to be led by the things that have, the catch-up trades, the things that haven't done so well, because we need a weaker dollar for that. And, for people listening to this saying, okay, I maybe understood some of it, or, I frankly might not even care what you're saying, Quinn. How does it affect me? One of the things I would say is hold on to your mortgage. If you have a good mortgage rate, hold on to that, because that's high quality asset. And the other thing is if we get any sort of emergency affordability measures for housing, that Besson and Trump are floating, whether that's interest rate reductions or stimulate, $50K off if you're first time home buyer, any of this sort of thing. Yeah, you probably want to buy as many houses as you can. You probably want to go full Lisa Cook, fabricate however many mortgage applications you need to
not financial advice. Do not commit fraud. You cannot come on my podcast and promote fraud.
No, it was all jokey, but you're going to see just continuous going into 2026. You're going to see continuous. It's an election year. We know what they do in election years, continuous stimulus measures. It's going to be very tough to see a nominal recession. And this inflationary world we're living in is going to persist. And so, I think factoring that into your asset allocation decisions is just drastically different than 2000 to 2020.
Yeah, I agree. I think, the key thing that stands out from that answer to me is just education, right? Like, I think it's easy to get confused and to shrug your shoulders and give up. But it's important not to get deterred by that. You get discouraged, keep learning, stay confused. It's okay. Everybody's confused. That's why we have all this disagreement. Like the Fed governors are disagreeing. Nobody is quite sure about anything. So that's an okay place to be, but just stay educated, stay engaged, stay bullish if you can. Quinn, where can we send people to find more of you and your work online?
Yeah, we have a website, www.lekkercapital.com. It's slow to get updated when you're a small startup, but and then I'm on Twitter at QTom. Took a summer hiatus, but probably be back on here and doing more of this stuff now. And our weekly forward guidance every Friday, we do a roundup with Felix and Tyler over at Blockworks. So I'm usually out and about, or reach out, DM me.
Yeah, and I've been a big fan of forward guidance for years, so definitely encourage our audience to check that out. Quinn, this was a lot of fun. I learned a lot. I hope you had a good time too, and I hope we can have you back on Milk Road Macro again soon. This was great.
Absolutely. Thanks, John.
Thank you. Thank you, everyone, for joining us. I hope you will, like we said, stay educated, stay informed, stay bullish, don't get shaken out, and we'll see you next time on Milk Road Macro. Thanks for being here, everyone. Bye. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.